Oh, YouTube is up. What's up, guys? You guys caught me in the middle of watching an incredible race right now, MotoGP. These guys are in Thailand right now, racing in the rain. Is insane right now. All right, let me stop this video. That's crazy. These guys are at it. You'd think they'd go slipping and sliding all across the track, but that's not even what we're talking about. I just wanted to get that out there because I thought it was crazy, and I was in the middle of watching it as I was waiting for everything to load. Welcome, guys. Justin R. Harris here. Welcome to my business investments side of the conversation. You guys know my playlist. I have the business channel and then I have my investments channel. And right here on this one, we are covering, you see the topic, the US dollar crashing the market. This is not a joke, but it's important that you guys understand now. No, I am not an economist. I am a commercial real estate investment consultant specialist, everything from developing to doing pro formas for your investment portfolios and packages and things like that. You guys know what I do, right? For those who follow. For those that don't, you just think I'm some dude with an amazing looking beard talking to you on YouTube and Instagram and all that great stuff. We're on what? Right now, I think I'm talking to you on YouTube. We are live on LinkedIn, and then we're live on Facebook right now. So we're covering all the great platforms right now. I'd love if this was able to do some sort of stream, maybe even like a live kind of thing on Twitter, but they just haven't gotten their product up to that point. They like their Spaces thing, I think, whatever that is. So it's great. It's a little chat thing and group kind of, yeah, cool. All right, so you guys know the topics right there. We're definitely gonna get into those. You know what I need you to do: like, subscribe, follow, get all that out the way so we can get right into it. I'm gonna take you guys and update you on some Zillow information from their economists. I'm gonna give you some info from Redfin. Definitely got to hear about what they're saying about the mortgage rates and how all of this is actually being affected by the dollar, okay? And then at the same time, who else are we going to talk about? Oh, NAR has a great little statement that they made. I'm not going to say little. It's National Association of Realtors. They're a big deal. But they actually made a good point, too, as to where we're headed. And then I also got, and that was actually quoted from some information on the Market Watch, as we are obviously going to cover a little bit, just touch on how the market is being affected by this and why you guys are seeing such a crazy downtone. I'm not even going to touch Bitcoin right now and what's happening there. I mean, what? We're talking about Bitcoin being down like 60% almost? What? 60%? I feel bad for you guys out there in the crypto world. It's crazy right now. I know a lot of people are jumping ship right now, and then you have those that are holding on for dear life because they have to, because they've lost so much now that it's like you might as well just stay there and just leave it alone, right? And then you have a lot of people just kind of walking away. I noticed that that conversation is not the popular conversation, and then I'm seeing all these different currency exchange buying each other out, merging and stuff like that. That's exactly right. That's how it happens. And all those small dogs, they got to get sucked up, buy them out, and come up with something a little bit smarter and revamp and put it back together again. It's not a failure. What you need to do is look at what you did, put it together, and step back out there again. It's an experiment, right? Every business is an experiment. If you walk away from it completely cold turkey, then you failed, right? So, hey, without further ado, let's get right into it. So I told you guys some of the brief things that I wanted to cover, but the biggest thing is understanding why the US dollar is crashing the market right now. So if you understand the US dollar right now, first of all, this is the first time, the last time we hit the US dollar being this strong, they said it was what? What are my notes saying? 5 decades, 50 years. It has been 50 years since we have been at this height. It's happened a few times in between there, but up to 50 years that it has been where we've gotten up to this point as the value of the dollar, and it's still not going to come down yet, right? So you have to understand why that's happening for those who want to know money and want to know what they're doing to move forward. Where are we headed? Are you just following blindly on what the media is saying to you right now? Or are you actually researching to understand what to do with your money? What are you supposed to do? You have some people running around saying, hey, go buy silver. Then you have some people running around saying, hey, go buy land, go buy gold. You need to put your money over here. Buy some artwork. Listen, all right, so if you had to really make a decision, I would spend more of your energy trying to understand why we are where we are now, and historically, how did we get here? When was the last time we were here? By looking backwards at those things, you can understand how we fixed it the last time we were at a point very similar to this. Maybe look again further back, and then look again even further back again. Those were all different circumstances, but the results were the same. And it's like an up and down, like you're looking at an EKG monitor at the hospital, okay? So you see the up, down, up, down, up, down, up, down. Literally, that's life. We're not going to continue to see this. If we continue to see this, we have a real problem. And you don't want to see this because that means there's no growth, right? That's flatline. You're dead, right? So you have to understand how the dollar is doing it. So why? Why? All right, let's get into that. Let's talk about why. So the Federal Reserve has a plan. We've been doing this quantitative tightening. You guys see that they keep raising the points. So when they say, oh, 0.75, 0.5, that is not us as consumers directly. That is the borrowing number. What did I write that down? That is the federal bonds rate, if you will. So that number, like we're at 3.25 right now. Okay, so being at 3.25, the federal bonds rate, that is all the banks that want to do business with them, that is their cost to do business. So because their cost to do business has gone up, now the consumer, our cost to do business goes up. So when you want to go and you want to borrow money, it becomes more expensive for you and I to go to the bank and say, hey, I want to do this, I want to do that, and you get these credit cards. Credit cards are going crazy right now because they know that they're slowing down. If you haven't seen it already, your emails should be blowing up with all these crazy credit card offers. You're probably getting stupid mail, right, about all these, how much you qualify for, and raise your current balance with this credit card and that credit card. It's because they need business, right? They need you to borrow and keep using their money so that they can make more of the interest that you're borrowing on because the interest rates are going up. So you have to understand that because that's all the adjustable rates. The fixed rates, when you lock into those, it is what it is when it comes to a mortgage, right? If I'm not mistaken, we're at 7%. So 7.03 or something like that, phenomenal. I think, you know, just my wild guess is that we're probably going to be somewhere closer to 8, maybe 8.5 by the end of this year, you know, if we do any cooling down. So why am I saying that? I even think we're going to be into 8 going into next year, 2023. The reason why I'm saying that is because Federal Reserve has already painted the picture for us. They already explained, listen, our goal is 4.25, right? Nope, 4.5. I had to double check my notes for a second. All right, so if we're going to get to 4.5, that means that we're still on the uptick here. So if it's 4.5, what happens? Why is the market crashing? Well, the safer bet is in the bonds, because if that's going up, that means the cost to purchase the bonds, that price is coming down. Well, the way it works is when the price goes down, the interest goes up. So right now, the interest looks very favorable. So if I'm in the stock market, I'm going to pull my money out of that and I'm going to buy bonds. Well, if I buy bonds, then it's safer for me because right now it's 4% increase. So I'm going to do better over here because the market is hurting over there. Well, if I do that, then I'm on a safer bet. Well, let's see, who else invests in the U.S.? Other countries, right? So that's why you're seeing what's happening in the other countries, as there's a larger and larger gap that's happening between the value of the U.S. dollar and everyone else's dollar, right? The U.S. is looking like the popular game to play. So as a result, our dollar keeps going up. But our market is going in the opposite direction because no one is playing ball there, because it's more expensive now for those businesses to do business outside the U.S. because their dollar's weaker. So when you do business at their dollar and then go and exchange it back to the U.S. dollar, you're actually losing money. So if you haven't noticed already, there are more and more advertisements as well happening where people actually want to do business here in the U.S. Buy U.S. You're going to start seeing more of that now. Buy U.S. made, buy more. So we need to strengthen here, spending our money here, not spending our money as much outside. Well, if we're spending our money here and other countries are spending our money here, then you're going to start seeing more of the progress that we need to see. And when that happens, then you start seeing the change in direction with our economy. When that happens, and the bond now becomes more expensive, the interest rates drop because we're now in a favorable condition, because now our inflation starts going in the opposite direction, in the direction that we want. The gold Federal Reserve wants to see is 2%, right? I don't think we're going to get 2, but we're definitely going to come down. I would say 4, and they're going to be happy. And so when we start getting closer to that number, then things are going to start looking a lot better for us, right? And that's really the goal here. So I'd hate for you guys to not understand what's happening, but that's why you see the market. So when is the right time to play? So I told you guys several videos back, be ready and prepared. Don't get caught in the sucker rally. That is literally the name of that video, the sucker rally. That's the rallying of the stock market. You got a lot of people that jumped in and went and bought tons of it because they thought that was going to be the turnaround of the market. And I'm just sitting here watching. I'm watching this stuff happen. I'm watching it. First of all, if you're doing your investments based on what the news media is saying, you should be slapped all across your house. Someone just go over there and just slap you all over the place. Listen, it's going to continue in this direction. The moment you start seeing the announcements that the Federal Reserve is starting to see favorable conditions, that's when you start paying attention to what companies, your ETFs, your dividends, and things like that, on what to play in the market. What companies are still there? Because I have a feeling that as it gets lower and lower, you're going to start noticing some of the bigger, stronger companies buying out some of the smaller ones because their stocks, their shares, their value of their company has gone so low that they can't sustain. You're already seeing the layoffs. You're seeing it in the news right now. Big brands are starting to do some major layoffs, hiring freezes, things like that. That is all of that is a clue. Pay attention. Keep telling people, pay attention. You're going to know what to do. Don't get caught up in the nonsense, and you'll be perfectly fine. I think I covered all the basic notes that I wanted to cover. I also want to make sure that I give you guys some info on exactly what I pulled up here. So first thing I'm going to do is I'm going to show you guys exactly where, when I Google, you guys know I jumped on the Google, and I'm always Googling first because I want to see what Google is going to tell me about interest rates. First thing I did was jump over and I showed the interest rate. So let's just slide on over here. So you guys see me in my bubble. Hi, I'm in the bubble. All right, so there it is. Look, 30-year fixed rate, 7.5. I keep telling you guys, dude, that's why I'm like, hey, listen, it's going to happen. We're going to hit 8, and I'm pretty sure we're going to carry 8 all the way into next year. Christmas is going to be tough. You're going to borrow a lot of money. Man, you're going to be working it off. Plus, the unemployment rates, they're not fairly reported. I think someone else did a video on that. I've been saying it. The numbers are inaccurate right now, but let someone else talk about that. I'm not going to cover that. So then what happened was I go over to Redfin, right? And Redfin's talking about the housing market. I've had quite a few other people that are talking about it right now. But look at this. Typical home buyer's mortgage payment up 15% since mid-August. Listen, 15% is a lot. You take whatever you think your number is for your mortgage and add 15% on there and tell me if that's okay, right? You're probably getting rid of one of your cars now. You know, you're trying to significantly consolidate your bills at this point, right? And it says, look at that. Sellers should adjust their price to stay competitive as mortgage rates approach 7%. Here's a little bit of advice. If you're a seller, if you are a real estate agent and you primarily do residential, this might work for commercial, but I don't know how many of these are available. Check into whether or not their loan is assumable. Because if their loan is assumable, you can work something out and jump in at the rate that they had it. And guaranteed, if it was in the past 5 to 10 years, they have a decent rate. Much better than your 7 and 8% that we're creeping up on right now. Okay? Just common sense. Think about that. Look at it. Talk to your seller. See if the lender has that program and if they can jump on it. Not all loans were written that way, but if it's assumable, man, you got a great deal, and now your buyer is going to be a lot happier and smarten up here on your deals. All right? It says, look at this. House hunter looking for $500,000 on a home saw their potential total mortgage payment fall by $64,000 from July to August, and then jump by $118,000 from August to September. Seesaw in mortgage rates which have swung from early 6% to below 5% to above 6% in the last 3 months, are causing headaches for home buyers. Now listen, I think banks did that prematurely. They should not have gone ahead and rushed to get us down to 5 to make it look all gravy, just so they could turn around, and now they're forced to go up to 6, and they're gonna come up to 7 and some change, and it's gonna keep creeping. And that's just for the perfect borrower, okay? They're not even talking about that yet. They're talking about you being the perfect borrower, okay? Let's not even go there, okay? So then I switched over and I jumped on marketwatch.com and was reading what they were talking about. And one thing that caught my eye is exactly what they said right here, okay? It says, see the best mortgage rates you may get here. It goes, though Hale points out, and he's talking about Hale. Hale is with, who is it there? We'll circle back with that. I think there was one of the Federal Reserve that points out that there aren't any Fed meetings in October. She says Fed speakers are out and about addressing various audiences, which will undoubtedly create room for investors to parse what they were saying for additional policy insights. The next Federal Reserve meeting in November and December are likely to be eventful. Eventful, nice way to say that. With investors and mortgage rates both anticipating further short-term rate hikes in these meetings. Of course, they're segueing for you to let you know it's coming. It's definitely coming, right? It goes, 3 factors mainly affect today's market: expectations on inflation, economic growth, and Fed's policy. 100%. Okay, as inflation remains stubbornly elevated, the Federal Reserve will continue to raise interest rates in its efforts to curb high inflation. That's exactly what I just said. Listen, their goal is 4.25. They're going to cut it off at that point, okay? They're not going to go back, because at that point, we're really up there. They're expecting that number will be our saving grace, okay? And it's already happening, especially as the bond purchases the price for bonds has dropped. It's a fire sale. It is a complete encouragement for everyone to invest in the U.S. dollar, as we are looking the strongest right now, right? So this Jeff Tucker, senior economist at Zillow, says rate changing this quickly means buyers can feel frozen, as what they can qualify for can change week to week. If you don't have a qualifier, if you're not qualified now, you're not going to be qualified next week, right? Or if you did, you might. And you're going to need to lock in your rates ASAP, okay? And that's the problem. It's the problem we're having right now. This is having a chilling effect on both first-time home buyers and move-up buyers, sellers. I can't even explain that any better than. And then we talk about the market. Their take on why the market is, I feel like they just don't want people to freak out, right? I told you why. It's safer. It's a safer bet. Everyone's going with the safer right now. They're not out there playing. Day traders, they're probably playing more of the short game right now, right? You're going to have to short more than you're actually trying to buy on the up, right? So you want to be smarter with that. That means a lot more margin calls. So, hey, you know what? Just be careful. So all I can really say there is be careful. He goes, look, rising interest rates are the main culprit. The Federal Reserve is raising its benchmark interest rate in historically big increments and plans to keep raising them. Exactly what I keep saying. It's more and more from credible sources on exactly what I keep telling you guys. So just pay attention to that. I'm not going to go through all of this. Definitely check out some of the updates on the Market Watch. You don't want to get caught hanging on that. But listen, I mean, it's not sad. It's a plan, okay, if you will. You have to understand what quantitative tightening means. You have to understand the overall job of the Federal Reserve when it comes to the respect of the dollar, global currency, and what that means with trading as a superpower and our position in the world, okay? So as long as you can understand those things, you can put your feelings aside for a second, then you know what to do moving forward. You know how to invest. You know how to save. You know how to basically live frugal enough to make the right decisions to protect you and your family. That's really what it comes down to. Thank you guys for checking in. Don't forget, like, subscribe, follow. That's really it. I've covered it. I banged it all out. I got it in about 20 minutes, less than 20 minutes. Thank you guys for checking in. See you later.